How's it going today, guys? Welcome back to Stock Radar. I know this is a different view than you are used to, but my mom is actually in the process of moving and I have my studio set up over there for when I do my Stock Radar videos with the black backdrop. And so for a couple of weeks here, hopefully not too many, I'm going to be just using PowerPoints while I get my new studio situated at her new place. So hopefully it's not an issue, and if you guys by chance prefer this layout, let me know. I do know that when I do the videos like this, I can use a lot more visual examples, and I'm just curious what you guys think, whether or not you prefer this type of video or the ones that have been the ones I've done previously where I have the actual chalkboard and draw that stuff out on the board. But anyways, what we are doing today, we are talking about Starbucks stock for our weekly analysis, so let's go ahead and get into it. So first of all, the symbol for Starbucks is SBUX. They trade on the NASDAQ. They have a price to earnings ratio of 18.3, a dividend yield of 2.1%. Now, as far as that dividend goes, they have just an 8-year history of paying that dividend and only a 4-year growth streak. They did have to cut that dividend, and I will show you guys when that happened. They have a market capitalization of $79 billion. The type of investment this is, it's an income and growth investment because they do have a relatively high dividend, and this is a 47-year-old company. So a little bit more background on Starbucks. This is a worldwide roaster, retailer, and marketer of specialty coffee. They sell coffee and tea drinks, ready-to-go beverages, whole bean and ground coffee. And if you guys hear that beeping, that is my laundry finishing up. I apologize about that. Pastries, breakfast, and lunch items. They sell products through Starbucks-owned stores as well as licensed stores. For example, Barnes & Noble has a lot of Starbucks in them, grocery stores, airports, sometimes college campuses. And a lot of people don't realize this, but Starbucks is not a franchise. All of the stores are either company-owned or they are licensed, where the licensees are managing and running those stores. Now, as of April of 2018, they have 28,209 stores. They have a massive amount of stores all over the world. And as far as their operating segments go, they operate under 4 different segments. First of all, the Americas. Second of all, China, Asia, Pacific. Third of all is Europe, Middle East, and Africa. And then finally is their channel development, and that is their sales through non-Starbucks retailers. So that would be their sales through their grocery stores and things of that nature. So just a couple of examples here of the different ways that Starbucks is selling their products. First of all, on the top left, that is a Starbucks-owned store. On the bottom left, that is a licensed store that looks like it's in an airport based on the background of that photo. And then in the middle there is a Starbucks cooler, and that is an example of their channel development where they are selling directly to the consumer through a grocery store. And it looks like, by the looks of it, this is a cooler at a Target store. And then as far as the brands under the Starbucks name, these are the ones that we are most familiar with. We have Starbucks Refreshers. They have Seattle's Best Coffee. They have Tazo, which we're going to talk about later on. They actually just recently sold off that tea brand. Of course, we have Starbucks Coffee, the most well-known brand for them. Starbucks Via Instant, that's their instant coffee line. Recently, they added La Boulange, and I apologize if I'm not pronouncing that right. That is a cafe and bakery from San Francisco, and they now sell those bakery items in select stores. I'm not sure if they're in all the stores, but they are at least in some. A lot of us are familiar with the Starbucks Frappuccino. It's a very popular drink among teenagers especially. Teavana, another tea retail store. Evolution Fresh, that's like their health juices and products of that nature. They have the Ethos Water brand, and then the Starbucks Double Shot beverages. So now let's go ahead and talk about the pros of investing in Starbucks stock. And first of all, one of my favorite things about them is their mobile order and pay, where people can order their Starbucks food and beverages right from their phone and then pay for them on their phone as well, and then just go to the store and pick them up. People are very impatient these days. A lot of people are not willing to wait in line for a coffee or a breakfast sandwich, and the ability to do this right on your phone is a very convenient service. And the reason why I have Panera in parentheses there is because Panera is also doing a great job at this as far as the mobile ordering and mobile paying for Panera. It's something that is very important, and it's good to be seeing Starbucks getting into this and doing this because it, again, ties into the fact that people are not very patient, and it ties in with that busy lifestyle. So that is a definite plus here for Starbucks, is the fact that they do the mobile ordering and paying right from your phone. And then the other pro here is that there are very loyal customers to Starbucks. A lot of people incorporate Starbucks as part of their daily routine. I'm very outspoken about this on my channel, of that being a waste of money, spending your $5 a day at Starbucks or more. In fact, one of the first videos I did on my channel that really went viral was about how to become a millionaire with $5 a day, and I was picking on Starbucks there and saying that for the cost of your Starbucks cup of coffee, you could be becoming a millionaire over the course of about 50 years just by investing that money. And so I'm not a big fan of buying coffee out of the house. I make coffee at home for 30 cents a cup, but a lot of people out there incorporate this as part of their daily routine, and they're spending money at Starbucks every single day, and they are very loyal to the Starbucks name. A lot of people even wear Starbucks, the logo on their shirts, and it's kind of an ongoing rivalry of the Dunkin' Donuts fans versus the Starbucks fans. And again, that just bodes very well for Starbucks as far as that customer loyalty goes. Now, another pro I have for Starbucks, and this is something we don't talk about often when looking at a stock, but they have very loyal, happy, and well-treated employees. They treat their employees very well, and they offer amazing benefits to both their part-time and full-time employees. And I believe they call this Total Rewards. This is something I got from their, it looked like their employee onboarding packet. I was doing a little bit of research just to see what kind of benefits you get as a Starbucks employee. And it says, once you become a partner, visit the Partner Hub to learn more about the programs available to you. Their base pay, obviously determined by your skills, experience, and job performance. They have bonuses based on specific business goals for eligible positions. Their benefits include health coverage, income protection, time off, tuition reimbursement. They're huge on that. Even with part-time employees, they have set up with a certain college, and they offer tuition help and encourage their employees to continue on with education. They also have employee assistance programs and more. They have Future Roast, which is their 401k savings plan, including Starbucks Match to help you save for the future. And they also have a stock investment plan there for their employees, offering discounted stock purchase plans. And Beanstalk, our equity reward program, allows you to share in the company's success. And so this is a company that is very heavily invested in their employees. It makes for loyal, happy employees. And at the end of the day, that's going to result in better customer service. And it's very important to have happy employees in a service business like this, because a lot of the reason why people return to Starbucks is because of the way they are treated by the employees, the fact that they remember their beverage and maybe write a drawing on their cup or something like that. It's those little touches that keep people returning to Starbucks each and every day. And that again just ties into that loyal aspect of this business, and the fact that the employees are very happy there and they are treated well. So that is something we have to talk about here as well with Starbucks, is they are a very ethical company and they treat their employees very well, and that creates a very positive customer experience. The other pro I have for Starbucks is Starbucks Reserve. This is something I just learned about pretty much doing this research here, but Starbucks Reserve are these premium Starbucks stores in city locations. They are like an upscale coffee bar targeted towards high-end customers in these city locations like Seattle and New York City. There were a few others on that list as well. And believe it or not, the price is as much as $12 a cup for some of these high-end beverages. So they're going after a very high-end customer base with these Starbucks Reserve stores, and they are very dedicated to this new venture, so much that the former CEO, Howard Schultz, stepped down from CEO to focus his efforts on the Starbucks Reserve in 2016. So this is a very interesting venture for Starbucks, and it's a bit unheard of to be hearing about a $12 cup of coffee, but if anybody can pull it off, it's going to be Starbucks. And then here's a couple of pictures of these Starbucks Reserve stores. If you've ever seen a Starbucks before, I'm pretty sure it looks nothing like that bottom right photo. That looks like a 4-story Starbucks store. That's absolutely amazing. At some point in time, I'd love to go check one out. But as you can tell here, they're going for a much more elegant, Gothic, and upscale design here, more like you would expect from an actual bar that serves alcohol. And so that's kind of what they're going after here, is the small brews of coffee and small batches of coffee, and going after that high-end customer base with stores like this. And it will be very interesting to see how this pans out for them, but it's still very early on in the process. So I don't think they're opening too many of these stores, but down the road I could see this being a huge potential opportunity for them, going after that high-end customer market, particularly in the metropolitan areas. The other pro I have for Starbucks is that they have global market exposure. And here we have from the annual report on the left-hand side, that is the licensed stores under Starbucks, and on the right is the company-operated stores. And just to go through this here, this is from October 2nd of 2016 to October 1st of 2017. In the Americas segment, they opened 646 new stores, giving them a total of 7,146 licensed stores. They opened 701 in the China, Asia Pacific region and 398 in the Europe, Middle East, and Africa segment. So it looks like they're doing an equal number there of both Americas and the China, Asia Pacific, and Europe, Middle East, and Africa was slightly behind that. But what's interesting is when you look at the company-operated stores that were opened, they opened, again, an equal number of the stores in America and then China, Asia Pacific, but they only opened 16 company-operated stores in the Europe, Middle East, and Africa segment. I'm not really sure why that is, but for whatever reason, they opened significantly less company-operated stores in that region or segment, but nonetheless, they have been investing pretty much equally in the different operating segments. And again, I always like investing in companies with global market exposure, and I think that Starbucks has a lot of potential with expanding in these different areas. Another pro I have for Starbucks is the fact that they have low staffing requirements for a lot of their stores just because a lot of their foods are pre-made and all they have to do is heat them up in an oven. A lot of coffee shops require a lot of staff on hand just because they are making stuff fresh. And while that might be appealing to some, when you think about the fact that they have greater staffing requirements, it might not actually make sense for them as far as the bottom line there and what they're making. And so for Starbucks, because they have lower staffing requirements, they are able to open up in locations where other local coffee shops might not be able to afford to, just because they have lower staffing requirements, meaning they can have a break-even point at a lower volume of traffic coming into that location. And then the other pro here is that because their beverages are notoriously more expensive, they have better margins. And now this data here was from, I think, 2014. I'm sure the prices have increased some, but this was a comparison of the cost of a large 20-ounce hot coffee at Dunkin' Donuts, McDonald's, and Starbucks. And as you can see here, Starbucks came in significantly more expensive than both Dunkin' Donuts and McDonald's at $2.25 versus $1.95 for Dunkin' Donuts and just $1 for McDonald's. So they're not really competing on price here. They're very comfortable with charging a higher amount for their coffee. But again, customers are very loyal to Starbucks and they are willing to pay that. And because they are charging more for their beverages, they have better margins on that and they're able to make more money. And so that is good for Starbucks, as they are able to comfortably charge more and have better margins as a result. The other pro I have for Starbucks comes down to actually looking at the valuation of this company, looking at 4 key financial metrics here: the price to earnings ratio, the forward PE ratio, the price to earnings to growth ratio, and the price to sales ratio. So I grabbed their top 2 competitors here as well, which are obviously Dunkin' Donuts and McDonald's. As far as that price to earnings ratio goes, Starbucks has the lowest PE ratio at 18.3 compared to a 27.8 for Dunkin' Donuts and a 21.4 for McDonald's. Now, based on the forward PE ratio, McDonald's appears to be the cheapest with a forward PE of 19.5. Dunkin' Donuts has a forward PE of 21.4, and Starbucks has a forward PE of 20.8. So Starbucks is still at a lower forward valuation than Dunkin' Donuts. In terms of the price to earnings to growth ratio, Starbucks is by far the cheapest at a 1.6 compared to a 2.3 for Dunkin' Donuts and a 2.5 for McDonald's. And their price to sales ratio is significantly lower as well at a 3.4 compared to a 6.2 for Dunkin' Donuts and a 5.5 for McDonald's. So now that we covered the pros of investing in Starbucks stock, it's important to talk about the cons, and there is a very big con here, and this is the shop small, shop local trend that is primarily starting with the younger generation and the millennials, this idea of shopping small, shopping local. And there's really a boom of these small coffee shops opening up that are really going to be taking away market share from these large beverage companies like Starbucks, Dunkin' Donuts, and McDonald's, where people are more willing to be spending money at these local stores, even if it's more expensive, just because they want to shop local. And this was a snippet from an article here from Fast Company, I believe. It said, while pumpkin spice and eggnog lattes still drive a lot of coffee shop traffic, with brand loyalists picking up their favorite drinks at Starbucks, Dunkin' Donuts, and the like, growth was largely driven by independent coffee shops. This again shows that trend emerging. Those shops saw 5% growth year over year compared to larger coffee chains, which saw less than 1% year over year growth. The coffee category overall perked up by 1.7%. So the growth is in these independent coffee shops, not these large commercially owned coffee shops. And this is because of that trend that's occurring here where particularly millennials are spending more money at these local coffee shops than they are at these chains like Starbucks and Dunkin' Donuts. And I believe this is a serious threat to Starbucks, is that they're up against these smaller coffee shops, and they will never be able to have that same small shop local feel that these coffee shops do. The other two cons that I have for Starbucks are the fact that they are seeing a decline in the same-store sales. And same-store sales are basically the sales from stores that are over 1 year old. It's a way to see if sales are growing for their existing stores by removing the data from their newest opening stores. So on the right there, this is from Motley Fool. This shows the same-store sales for Starbucks since 2013. The blue line is the Americas, the red line is the Asia Pacific, and the orange line is Europe, Middle East, and Africa, and then the green line is the consolidated data across all of those. As you can see here, same-store sales are declining. And again, this is just a result of the fact that they have really begun to achieve market saturation where they've grown to be so large that they're just not finding new customers. And then the other con that I have here as well is that we are seeing a lot less traffic in shopping malls, and a lot of Starbucks stores are in shopping malls. And then when you think about Teavana, all of those stores are pretty much in shopping malls or outlets. And the lower traffic in the shopping malls is not a very good trend for a company like Starbucks, especially because of the fact that they have Teavana under their name. So these are two major cons here I have as well. It's that decline in the same-store sales, which I believe is a result of just market saturation, and then the death of the shopping mall, or at least the decline. This is a very bad trend for this company, and I think it's why they're having a lot of problems with the Teavana brand. And then the other con I have for Starbucks stock is bottled water is becoming a very popular beverage, and this is part of that larger health trend of people not drinking sugary beverages. And while there are healthy alternatives at Starbucks locations, and Starbucks does sell bottled water, more people are just drinking bottled water in general. And there may be people that are switching to a bottle of water from home rather than going to Starbucks and buying their Frappuccino just because they are looking to be more health conscious. And proof of this is this data here from Statista. This is sales volume of bottled water in the United States from 2010 to 2016. And as you can see, we're seeing significant growth in the sales volume of bottled water because more people are jumping on this trend, being healthier and drinking water instead of other beverages. And this is going to naturally affect Starbucks because of the fact that people might be replacing their Starbucks fix with a bottle of water. Now, I do give them credit because they do sell bottled water, which is a plus. But again, this is just an ongoing trend here, and more people, I believe, are going to be drinking bottled water and being more health conscious and spending less money on their sugary beverage fix. So moving on now, let's go ahead and talk about the barriers to entry for Starbucks. And if you're noticing this is a small list, it's because they don't really have great barriers to entry, in my opinion, other than two things here. First of all, the brand. A lot of people really like the Starbucks brand. They're a very reputable company, a very ethical company, and people really like the Starbucks brand. And second of all, it's that customer loyalty. But beyond that, at the end of the day, they're selling food and they're selling beverages, and they're always going to be more expensive than their key competitors, Dunkin' Donuts and McDonald's. And so they always have to rely on that customer loyalty aspect in order to have people continuing to come into the stores. Now, like I said, they treat their employees very well, and you always have a different experience at a Starbucks store than you do at a Dunkin' Donuts. And in my opinion, they do have better quality control. I used to be one of those Starbucks junkies when I was working at my internship back in the day. I was making $14 an hour, and I somehow thought it would make sense to spend $5 or $6 in the morning on a Starbucks drink. I'd go in there every single day, and they remembered my order. They were always very friendly, and they would put a little smiley face on my cup. And even though these things don't seem very important, they really mean a lot to people at the end of the day. So people are always going to have that experience at a Starbucks for the most part, but is that really going to keep people around, especially when more and more people are going to be spending money at local coffee shops? Beyond that, it's a price-sensitive market, and when you have stores like McDonald's selling a $1 coffee in certain areas versus a $5 to $6 coffee at Starbucks, that's going to be tough for them to compete, solely relying on that customer experience. So I don't see very many barriers to entry here for Starbucks, and especially because they have a massive threat here with the shop local trend that is beginning to emerge, especially among millennials. Now, as far as that dividend goes, I wanted to quickly cover the dividend coverage here for Starbucks. We do know they cut that dividend 4 years ago, but the dividend coverage is great now. This is the earnings per share data from the most recent quarters. And as we've said before, we calculate that coverage ratio by taking the earnings per share and dividing out the dividends per share. And for fiscal year 2017, they did $1.97 in earnings divided by $1.05 in dividends, giving them a coverage ratio of 1.88. So Starbucks does have excellent coverage of the dividend, and they are in a good position to increase that dividend down the road. So I think they have a potential to be a very good income stock. So I think what happened with Starbucks is they got a little ahead of themselves early on with that dividend, then they had to cut it. So hopefully they grow it at a more slow and steady rate in the years going forward, giving them a better dividend growth streak. So now we're going to move on here and look at the fundamentals of this stock. And as always, we're going to start by looking at the assets. So total assets grew from 2014 to 2016, but stayed relatively flat from 2016 to 2017, and current assets have grown every year since 2015. Now, total assets grew significantly over the last 4 quarters, however, they declined in the most recent quarter. Total assets grew at an average rate of 10.4% per year over the last 4 years. However, total assets grew just 0.4% from 2016 to 2017. So the last 2 years here have not been too great for Starbucks. Now, that being said, total assets grew 20.9% over the last 4 quarters. And the other thing worth mentioning here is there was a significant increase in cash and cash equivalents from 2016 to 2017. So they significantly increased that cash pile. Moving on now, let's take a look at the liabilities. Total liabilities have increased every year since 2014 at an average rate of 18% per year, and long-term debt has increased every year since 2014 as well at an average rate of 24.6% per year. So what we can gather looking at that is that debt growth is significantly outpacing asset growth, and that is not something I like to see on a balance sheet. In fact, the debt growth was staggering over the last 4 quarters as total liabilities increased 48% over the last 4 quarters, and long-term debt increased 57.2% over the last 4 quarters. So if you are considering investing in Starbucks stock, I would keep an eye on the growth of the debt, particularly the long-term debt, just because that is not something I like to see as rapid growth of debt in a short period of time. So while Starbucks has adequate coverage of debt, and we're going to look at the liquidity ratios later, the rapid growth of that debt is worrisome to me. Moving on now, let's take a look at the income and the cash flow from operations. So total revenue has increased every year since 2014 at an average rate of 10.9% per year. So the revenue growth has been strong over the last 4 years, but total revenue grew just 5% from 2016 to 2017. So we saw a significant decline or slowdown in the growth of that revenue. Now, gross profit has increased every year since 2014 at an average rate of 11.8%, which is good to see gross profit outpacing the growth of total revenue. However, gross profit grew just 4.2% from 2016 to 2017 compared to 5% growth of total revenue, indicating slightly lower profit margins, which we'll see, I believe, on the next slide. Other than that, net cash flow from operations is relatively inconsistent, and it declined from 2016 to 2017. And then as we can see here, looking at the financial ratios, they do have adequate coverage of their debt, current ratio of 125%, quick ratio of 93%, and cash ratio of 64%. So despite the fact that they are taking on more debt, they are maintaining good coverage of that debt, and they have good liquidity ratios. And then when we look at the profitability ratios, we can see gross margin is steady. We saw a slight decline in operating margin from 20% to 18% from 2016 to 2017. Pre-tax margin declined 1%. Profit margin, however, was steady at 13%. And we saw an increase in the pre-tax ROE and the after-tax return on equity. Now, as far as the stock goes, the performance has been pretty bad over the last year, especially considering what the overall market has done. Starbucks stock is down 11.1% over the last year, compared to a 12.3% return from the S&P 500. And it's not like this stock is paying a massive dividend. They are paying a 2.1% dividend, but they should be seeing some growth in that share price, but we just aren't seeing it right now. Starbucks stock is, however, up 79.3% over the last 5 years compared to a 66% return from the S&P 500. So it has outperformed the S&P 500 over the last 5 years, but definitely not over the last year. Now with a beta of 0.51, this is a low volatility stock that is beginner friendly, so it is a good pick for beginners just because there's not going to be a ton of volatility based on that beta. And while the dividend is attractive and they do have good coverage of it, the growth potential is unclear as they are up against market saturation primarily and that shopping trend of shop small, shop local. And I believe people will always get their daily fix of coffee, and there are always going to be people who are loyal to Starbucks. But again, the threat of the smaller local coffee shops is very large, in my opinion, to both Dunkin' Donuts and Starbucks and also McDonald's. There's just going to be more people that are looking to shop local and spend money in their own community. And finally, we're going to wrap up here with some key financial notes from the Q2 2018 earnings report. Global comparable store sales increased 2%, driven by a 3% increase in average ticket. This is the same metric as same-store sales. Now, they tried to make that look good, but the truth is same-store sales increased 2% on a 3% increase in the ticket. So they actually would have probably seen a decline in same-store sales if it wasn't for the increase in the average ticket sale. And again, that is not something that you're wanting to see as an investor. And it's not like they're seeing any kind of crazy growth here. They're starting to see very slow growth due to the fact that they're achieving market saturation. However, we did see, China comparable store sales increased 4%, and so they are seeing, better growth numbers in the global markets, in the international markets, and that is where I see Starbucks having the most potential, is countries like China and India. So that is a good thing to see there, but again, we're not seeing any kind of crazy growth numbers out of this stock. Consolidated net revenue of $6 billion, up 14% over the prior year. Mobile order and pay represented 12% of U.S. company-operated transactions. That is huge for them. A lot of people are using that mobile order and pay that we talked about earlier. The company returned $2 billion to shareholders in the quarter through a combination of dividends and share repurchases. So they're very generous with those dividends and the share buybacks. What's interesting, though, is that it's mentioned that during the quarter, the company also closed 298 Teavana stores. I think this has been an absolute failure for this company. I've only been in one Teavana store before. It was in Burlington, Vermont. And as I was going in there, they told me, oh, you better stock up because we're closing. And I was like, oh my gosh, that's weird. I don't think they're very successful stores. I don't know if it's a result of slower mall traffic or that's just not a very profitable product or not a lot of tea drinkers, but I don't think Teavana has been a very successful venture for them. And they divested Tazo, which was another tea beverage, to Unilever in November of 2017, I believe, and so they sold off that brand. But anyways, guys, that's going to wrap up this analysis here of Starbucks stock. I hope you enjoyed it. Let me know what you think of this style of video over in the private Facebook group, and I will see you in the next video.